Let's now begin quick revision of Accounting Standards Applicability, Chapter 3 of our syllabus. This chapter has an amendment, and this amendment has changed the applicability of accounting standards for non-corporate entities. That is, the entities to whom ICAI will tell which standards are applicable and which are not. This change is applicable from September 2025 examination and onwards. September 25, Jan 26, May 26 and onwards. This is the new applicability. And after this amendment, this topic has become much simpler than how it was in the past. Let's start from the beginning. Section 129 subsection 1 of Companies Act talks about preparation of financial statements. It tells that the financial statements what the entity prepares should be in compliance with accounting standards applicable. And the applicability of accounting standards is usually given under section 133. 133 tells that what accounting standards are applicable and what is supposed to be followed in preparation of financial statements. Under section 132, NFRA, National Financial Reporting Authority, which is empowered to issue accounting standards or to mention accounting standards which are supposed to be followed by an entity in preparation of its financial statements are there, and that has to be followed. If in case you don't follow them, then as per section 129 subsection 5, as an entity you have the responsibility to disclose. What should you disclose? Number one, what is the deviation from the accounting standard? Meaning, what part of accounting standard is it that you are not following? Number two, why are you not following what is tells? Number three, what is the financial impact on the financial statements for non-compliance? If you had followed, this would have been the amount. Because you did not follow, this is the amount of that item, impact on profit, impact on balance sheet, everything. All these disclosures are mandatory under section 129 subsection 5. Further, following these accounting standards is not just the responsibility of the management under section 134, it is also the responsibility of the auditors under section 143. It is the responsibility of the management, that is directors, to check and to ensure that all applicable accounting standards are followed in preparation of financial statements, given in section 134 subsection 5 clause 8. Similarly, in section 143 subsection 3 clause E, auditor also should have to check whether accounting standards have been rightly followed. If not, he has to consider before giving his opinion, and would have to also mention in his audit report if all the accounting standards have been followed or not. If not followed, what is the impact of it on his opinion? Are the financial statements still showing true and fair view or not? We'd have to check this through. Like I mentioned, for the applicability of accounting standards, we are going to classify it into two categories. One, corporate entities. Two, non-corporate entities. For corporate entities, the power is with MCA, Ministry of Corporate Affairs. Further, sublet into the hands of NFRA, who will propagate as to what accounting standards are applicable to. For the purpose of applicability, MCA dealing with corporate entities has divided entities into two categories. One, non-SMC. Second one, SMC. SMC means small company, and non-SMC means not small, not medium company. So as per MCA, what is the classification? Two. One is SMC, second one is non-SMC. As per ICAI, which talks about what accounting standards and how is it applicable for non-corporate entities, anything other than companies like partnership firms, sole proprietorship, etc. For them, which standards are applicable and when is it applicable? Previously, if you remember, there used to be 4 classifications: level 1, level 2, level 3, level 4. Now there are no 4 levels, there are only 2, which is large entity and MSME. In the past also I told, out of level 1, level 2, level 3, level 4, level 1 as per ICAI is nothing but non-SMC as per Companies Act. Level 2, 3, 4 as per ICAI was equal to SMC as per Companies Act. Now it is large entities means non-SMC, small and medium companies. SMC means MSME. So as per ICAI, what is the classification? Large entities and MSME. Large entities and MSME. As per Companies Act, the classification is non-SMC and SMC. And non-SMC as per costing, non-SMC as per MCA and large entities as per ICAI are same. And MSME as per ICAI and SMC as per Companies Act are again same. So you understand the difference that I've explained so far for you right now is level 2, 3, 4 has been merged into one word called MSME, which is same as small and medium company. Okay, let's proceed. How do we decide what accounting standards are applicable to based on this classification? For a non-SMC as per Companies Act or for a large company as per ICAI, all accounting standards are applicable. No exception, no relaxation, and then nothing taken back. Everything is applicable. However, if it is an SMC, small company, A17 segment reporting is not applicable at all. And certain standards, there is relaxation. Relaxation means what? The standard is actually applicable, but some parts of the standard are exempt. AS15 actuarial valuation will not be applicable in employee benefits. 19 sale and lease back recognition will not be applicable for SMCs. 20 diluted EPS is not there. In 28, they don't have to do bottom up and top down test. In 29, provisioning beyond a point is not required for them. So this is for companies. If you come to non-corporate entities, as per ICAI, if it is a large entity, all accounting standards are applicable. If it is not a large entity, if it is an MSME, then not applicability is for several standards 3, 17, 18, 20, 21, 23, 24, and 25 and 27 not applicable. 3. Cash flow statement. 17 segment reporting. 18 related party. 20 EPS. 21 consolidation. 23 associate. 27 joint venture. 24 discontinuing operation. 25 interim reporting. All of these are not applicable. But if that entity is a company, then it is not that case. Then 21, 23, 27 will be applicable based on the event. If it is going into the process of holding subsidiary relationship, then applicable. If it becomes associate, if it becomes joint venture, then it is applicable. Or if it gets amalgamated, then 14 will become applicable. That way. And relaxation, meaning the standard is applicable with some paragraphs not being applicable. This kind of provision is there for 10 PPE discontinue, or say 10 LA we do discounting of the expected cost of removal of the asset. No, that provision is not applicable if it is a small entity. 11, certain parts of 11 are not applicable. 15, 19, 22, 26, 28, 29 is also not applicable completely. It's partly applicable, meaning standard is applicable, but there are relaxation with regard to some standard, some paragraphs. You don't have to remember these numbers. What is applicable fully, what is applicable partly, don't have to remember. No one remembers. It's absolutely fine. But in the amendment, there's something new given with respect to accounting standard 18 and accounting standard 28. They're telling accounting standard and accounting standard 18 and 28, it is not exempted for an SMC if its turnover is greater than 50 crores or borrowings is greater than 10 crores. You are a small company. Because you are a small company, not all accounting standards are applicable to you. Some standards are exempted, some standards are relaxed. But among the small companies, if you are such a small entity, not company, sorry, if you are such a small non-corporate entity whose turnover is greater than 50 or whose borrowings is greater than 10, then AS 18 and AS 28 will be fully applicable. For you to not have to follow 18 and 28, your turnover should be less than 50, your borrowing should be less than 10. Some new threshold has been given for non-corporate entities where applicability of accounting standard is as per ICAI's limit. This is something new. You can expect an MCQ on this anytime soon. Then coming to the chart, if you have seen the old chart, we had little more part here on the side, level 1, 2, 3. Now that's not there. Now it's simple. Non-SMC as per Companies Act is same as large entity as per ICAI. SMC as per MCA applicability or Companies Act part is same as MSA. How do we decide whether it is large or not large? Very simple. If an entity is in the process of getting listed, or if the entity is already listed, whether in India or outside India, whether equity instruments or debt instruments, then it is large entity or it is not an SMC. Are you getting it? Then the second point, kind of business they do. If they're into banking business, or if they're into NBFC, or if it is into insurance business, then it is a large entity or it is not considered as an SMC. To be calling it a SMC, small business, or an SMC or MSME, it should be not listed or in the process of getting listed. It should not be doing banking. It should not be doing NBFC business. It should not be doing insurance business. and it should not fulfill this turnover based conditions also. If turnover is more than 250 crores, or if your borrowing is more than 50 crores, or if your holding company or your subsidiary company or any of your group company is already a non-SMC by any of the criteria, then you also become non-SMC. If in case your turnover is 250 or less, your borrowings is 50 or less, and you and your entire group, holding subsidiary, everyone together, none of them are non-SMC, none of them are large entity, then you remain an SMC and MSME. Are you getting it? Even if one of the condition falls in the large entity category, you become a large entity. For example, you are listed, but you are not doing business of banking, you are not doing business of financial institution, you are not into insurance business, your turnover is less than 250, your borrowing is less than 50, none of your group companies are large entity, but still the moment you are listed, you become large entity. You are not listed, you are not doing this special business, your turnover is 251 crores, but your borrowing is also less than 50, and none of your group companies are large entity, till you become large entity. It is not all the conditions. Even if one of the condition is there in the large category, you go to large, and you don't just go, you take your entire group to large category. I hope everybody understood this. Okay, very nice. And when we talk about turnover of 250 crores, it is turnover of the previous accounting year, not the current year. It is a turnover of the previous completed accounting year, and it excludes other income. And when we talk about borrowings, it is borrowing of the previous year at any point of time. Some one day during the year, if your borrowings is more than 50, the trigger is being made and you become a large entity. So turnover is for the entire period, previously completed year, excluding other income. But when we talk about borrowings, it is at any point of time during the previous year. I hope everyone understood. This is the update on the new amended applicability of accounting standards.